Beyond the front door. Exploring AA-suggested alternatives to real estate investing for generations, real estate has been viewed as the cornerstone of the American dream, a reliable vehicle for building long-term wealth. However, the modern landscape has shifted. Rising property prices, high mortgage rates, and the constant burden of maintenance have created significant barriers to entry for many aspiring investors. To explore whether there are more accessible ways to grow wealth, we turned to ChatGPT. By leveraging the AI's analytical approach, we identified 5 primary alternatives to traditional property ownership that cater to different risk tolerances and financial goals. REITs, real estate exposure without the landlord hassle if you want to profit from the real estate market without the stress of managing tenants or repairing roofs. Real estate investment trusts, REITs, are a primary option. REITs allow you to buy shares in companies that own and manage income-producing properties, such as shopping malls, office buildings, or apartment complexes. The pros: they offer instant diversification and regular dividend payouts. The cons: unlike physical property, REITs are subject to stock market volatility and can be sensitive to interest rate fluctuations. Dividend stocks, generating passive income for those seeking a steady stream of cash similar to receiving monthly rent dividend-paying stocks, offer a liquid alternative. Instead of managing a physical building, you invest in established companies that distribute a portion of their earnings to shareholders. Income focus. This is particularly effective for retirees or those prioritizing immediate cash flow. The strategy: investors must choose between high-yield stocks, which often carry higher risk, and dividend growth companies, which offer lower initial payouts but more reliable long-term increases. Broad market index funds. The path of long-term growth, while real estate often relies on leverage, debt, and property appreciation, broad market index funds focus on the power of compounding across the entire economy. By owning small pieces of hundreds of different companies simultaneously, you reduce the risk of a single company's failure ruining your portfolio. Accessibility: you don't need to save for a massive down payment. You can fund these accounts gradually. Efficiency: they are generally low cost and highly tax efficient, making them a cornerstone for long-term wealth building. Bonds: prioritizing stability and predictability when the goal is capital preservation rather than aggressive growth. Bonds and bond funds serve as a defensive anchor. A bond is essentially a loan you provide to a government or corporation in exchange for regular interest payments. Current context: following recent interest rate hikes, bonds, such as U.S. Treasuries, have become more attractive for providing predictable income and protection against volatility. Role in a portfolio: bonds are rarely growth engines, but they act as a stabilizer when the stock market becomes turbulent. Small businesses and side income: the active alternative for investors who prefer sweat equity over passive market movements. Investing in small businesses or personal ventures offers a different kind of control. This can include fractional ownership in businesses, revenue-sharing platforms, or starting a side hustle. The trade-off: unlike the other options, this requires significant time, effort, and expertise. It is an active investment where your own skills drive the return, rather than just market trends. What to avoid? The speculation trap: when asked for recommendations, the AI was notably cautious about speculative assets. It advised against get-rich-quick schemes and highly volatile assets like cryptocurrencies as primary wealth-building tools. The consensus remains that sustainable financial security is built on diversification and extended time horizons, rather than chasing trends. Summary: while real estate remains a valid wealth-building tool, it is no longer the only path. Depending on your need for liquidity, your tolerance for risk, and the amount of time you can commit, these alternatives may offer a more flexible and realistic route to financial security.